On Monday in Mumbai, the rupee did something odd. It hit a fresh record low, near 91.99 per dollar. Then it snapped higher by about 0.5%. That kind of reversal is usually a clue. Here's the testable promise. You'll know why it bounced. You'll know what could crack next in bonds. And you'll have 3 signals to track this week. Start with the first receipt. In the RBI reserves release, the total is the headline. India's foreign exchange reserves printed a record. About $709.41 billion for the week ending January 23rd. That is the backstop the market keeps talking about. Now, the second receipt. The rupee still printed a new low near 91.9875 per dollar. That is what Reuters reported around the budget shock. And the same day it rallied to about 91.5125. That is not a calm tape. That is a market testing the edges. Foreign flows matter here too. Reuters put January net stock outflows near $4 billion. When the marginal buyer leaves, FX gets thinner. Small shocks move price more. Now, the budget. India published its federal budget on Sunday, February 1st. The borrowing number was the surprise. Gross market borrowing for the next fiscal year was set at $17.20 trillion. That is about $188 billion at recent rates. Reuters also flagged a fiscal deficit target near 4.3% of GDP and a debt-to-GDP target around 55.6%. Bond traders heard one thing. A lot of duration is coming. By Monday, the bond market repriced again. The 10-year government bond yield pushed up. Reuters described an 8 basis point jump on the day. They also flagged levels near 6.77%. That is the highest area since last spring. A yield move like that is not just a chart move. It rewrites the funding math. Here's the chain in plain English. More bond supply raises yields. Rising yields raise financing costs. Banks and dealers absorb supply, and balance sheets get used up. Liquidity tightens at the margin. When liquidity tightens, currencies get jumpy. Now bring in the anchor example. Picture a mid-size Indian importer. They buy electronics parts priced in dollars. They need to pay $10 million in 30 days. Last month, they budgeted at 90 per dollar. Now the market is flirting with 92. Their margin is not 2%. So they hedge. They buy dollars forward, or they pay for options. When many importers hedge together, dollar demand spikes. That can turn a drift into a squeeze. This is why reserves alone do not prevent pressure. Reserves are a backstop. They are not a daily promise. The RBI chooses its moments, and it uses tools. This week, the tool is swaps. The RBI has been running USD-INR buy-sell swaps. Reporting has focused on a $10 billion size, also a 3-year tenor. Here's what it means. Banks hand dollars to the RBI today. The RBI hands rupees to the banks today. And the banks agree to buy the dollars back later, at a set forward rate. 2 consequences come out of that. First, it supports the rupee without selling reserves outright. Second, it pushes rupee liquidity into the system. That liquidity can matter when bonds are heavy. It can also move forward points because the swap sets a price for time. Back to our importer with a new consequence. If forward points widen, their hedge cost rises. Even if spot holds steady, that is how stress can hide in the curve. The cross-asset snapshot fits. Rates moved first. The 10-year yield rose again. FX was messy. The rupee printed a new low, then rebounded. Equities did not implode. Reuters said major Indian indexes bounced more than 1% Monday. That, stocks up, bonds down, split often points to supply and funding stress. There is also a global layer. Reuters tied the pressure to a stronger dollar backdrop and to higher U.S. yields. When the dollar is firm, EM hedges get pricier. Risk budgets tighten. The next 24 to 72 hours are the first rung of stakes. There is a dated catalyst. A $10 billion swap auction is scheduled for February 4 in reporting. There is also an RBI policy decision this week. The base case in press is a hold. The market will still trade the tone, especially language on liquidity and bond market functioning. Here are the 3 signals to watch. First signal, watch USD-INR spot and 1-week implied volatility. Look at onshore USD-INR plus 1-week options pricing. If spot drifts back toward the lows and 1-week vol jumps, stress is rising. The lag is immediate. 1 to 2 sessions. Second signal, watch the 10-year yield and the next auction tone. Look at benchmark yield screens and auction tails, bid to cover, and dealer take. If yields keep grinding higher after supply news, buyers are stepping back. The lag is days. Third signal, watch foreign portfolio flows and the weekly reserves print. Look at NSDL or exchange-reported FPI flows, then RBI weekly reserve data. If outflows persist while reserves stop rising, the backstop looks thinner. The lag is 1 to 2 weeks. Now, zoom out to the next 2 to 6 weeks. AR's 17-20 trillion plan is not one event. It is a pipeline of auctions. If demand is soft, yields can keep repricing. That transmits into bank balance sheets and loan pricing. It can spill into corporate funding spreads. That is how a budget headline becomes real economy friction. For our importer, that is the next consequence. Working capital costs rise. Credit lines get tighter. Inventory gets pricier in dollars. Margins compress in rupees. If this persists longer, the breakpoint shifts again. A weaker rupee can feed imported inflation. That can complicate the RBI's path. Then the bond market can ask for more term premium, and the loop can become harder to stop. None of this is guaranteed. This can stay contained. Swaps can calm the FX front end. Bond purchases can help absorb supply. But the story stays live until those 3 signals cool. So, the question this week is simple. Was this a one-off budget wobble, or the start of a broader funding squeeze? The answer will show up in those 3 markers. On the swap itself, the detail is everything. A USD-INR buy-sell swap is not magic. It is timing. Dollars today, dollars returned later. Rupees injected now, rupees withdrawn later. The Reserve Bank of India uses it for 2 reasons. One is optics. Spot selling shrinks reserves instantly. Swaps can lean against the move without that headline. The second reason is liquidity. When the RBI sells dollars spot, it drains rupees. That can tighten money markets right when bonds are heavy. A swap does the opposite in the front leg. It adds rupees when the system needs them. Now take the budget shock and put it together. More government borrowing means more auctions. More auctions means more dealer balance sheet. More dealer balance sheet means more demand for funding. That is when overnight rates and short bills matter. Here is a clean way to visualize it. Think of 3 pipes. The bond pipe is supply and demand. The FX pipe is spot dollars and forward dollars. The funding pipe is rupee liquidity and collateral. If one pipe clogs, the pressure moves sideways. That is the anomaly scanner in real life. Spot can look calm while forwards scream, or stocks can bounce while bonds keep bleeding. You can see this with our importer again. They do not only care about spot, they care about forward points. If the 1-month forward premium jumps, their hedge cost rises even if spot stalls. That hits their pricing immediately. Then they either raise prices or cut orders. That is the real economy channel. Watch where forward points come from. They are driven by rate differentials and liquidity. If rupee liquidity tightens, short rates rise. Higher short rates can widen the forward premium. So the RBI has a reason to inject rupees, even if the headline is currency defense. There is a third receipt the market keeps citing. In January, RBI ran a $10 billion swap, and reporting said it was oversubscribed by about 3 times. That tells you demand for dollars was not theoretical. Banks wanted the facility. They wanted it at size. The risk is that swaps pull stress forward. You get calm today, but an obligation later. When that swap matures, the RBI absorbs rupees back, and dollars go back to the banks. If conditions are calm, then it is fine. If conditions are stressed, then it is a second test. Now connect this to the bond market again. If the 10-year yield is pushing towards 6.8%, banks mark losses on bond holdings. Dealers demand more return to warehouse supply. Mutual funds see outflows when yields rise fast. Foreign investors may step back if FX is unstable. Each step makes the next auction harder. That is the what breaks first pressure point, not the reserves headline, the auction tail, the dealer take, the secondary market depth. This is why the RBI meeting matters. Even if they keep rates unchanged, markets will read any line on liquidity. They will read any hint of support for bond functioning. They will also watch language on inflation risks. If the RBI sounds tolerant of INR weakness, the market tests the lows again. If the RBI sounds focused on stability, Spot can calm, but forwards can widen. Either way, the stress migrates somewhere. Now, put India in the global frame. A stronger US dollar tightens the world. Higher US yields pull capital toward dollars. That raises the hurdle for EM assets. It also raises hedging costs for foreign investors. That is why you can see outflows even when local growth looks fine. Back to our importer with a new consequence. If their bank raises hedge spreads, the importer pays more for the same protection. They may shorten payment cycles. They may demand better terms from suppliers. Suppliers may say no. That is how trade slows without a recession headline. In the next 24 to 72 hours, the first question is auction demand. If the next bond supply is absorbed cleanly, yields can stabilize and the rupee can breathe. If the auction is sloppy, the yield jump can pull INR lower again. In the next 2 to 6 weeks, the question is whether FX defense stays orderly. Orderly means smaller daily moves. Orderly means forward points do not blow out. Orderly means reserves do not fall sharply. Disorderly looks like gaps, not trends. And if this persists longer, the macro trade-offs get sharper. A weaker rupee raises import prices. That can lift headline inflation. That can make rate cuts harder. Then growth pays the price through credit. You do not need to predict any of that. You just track the markers. Here they are again, in plain terms. Spot and 1-week vol, a 10-year yield and auction stats. Flows and the weekly reserves print. If spot stabilizes and vol falls, pressure is easing. If yields stop rising after auctions, the borrowing shock is being digested. If flows stop bleeding and reserves hold, the backstop is credible. If those do not improve together, the stress is just moving around the system. One more place to look is offshore pricing. USD INR does not trade only onshore. There is the non-deliverable forward market too. If offshore forwards price a weaker rupee than onshore, that gap is a stress signal. It means demand is leaking outside the regulated pool. The RBI can push back with multiple levers. Swaps are one. Another is liquidity operations in rupees. That can be repos or variable rate reverse repos. Another is rules around bank FX positions. None of these are permanent fixes. They are pressure valves. If you want one plumbing receipt on screen, pull the RBI announcement for the swap auction terms. Show the date, the size, and the tenor, then show the USD INR chart around it. That is the policy action meeting price. For rates, a second plumbing receipt is the OIS curve. Look at overnight index swaps in India. If the front end lifts while policy is on hold, that is a liquidity story, not a rate story. If the back end lifts with it, that is term premium and supply. For credit, India is not a CDS headline every day, so you watch proxies, high-grade corporate bond spreads, bank funding costs in certificates of deposit, and equity vol in rate-sensitive sectors. If those widen while stocks are green, that is a mismatch worth flagging. Bring the importer back one more time. If offshore forwards look worse than onshore, their bank may price hedges off the offshore curve. That makes protection more expensive even at home. Then the importer cuts inventory. That shows up later in industrial output. It shows up later in inflation prints. It shows up later in earnings guidance. So the point is not that India is in trouble. The point is the system is being tested. Big borrowing plans test bond demand. Big bond moves test FX stability. FX stability tests liquidity tools. And the evidence shows up in those 3 markers. Now, let's put a clean bow on the mechanism. This started as a fiscal supply story. The budget sets the borrowing path. That pushes bond supply into the calendar. Supply pressure nudges yields higher. Higher yields change funding behavior. Funding behavior changes FX demand. FX demand tests the RBI's tools. That is why the rupee move matters. A record low followed by a sharp bounce is often intervention or positioning getting squeezed. Either way, it tells you the market was offside. Go back to the 2 big receipts. 1, the RBI reserves print was a record, about $709.41 billion. 2, the rupee still printed near 91.99 before rebounding. Those can both be true at the same time. A big backstop does not stop every test. Here is what could break first, if it worsens. Not the headline FX reserve number, not the daily close in USD INR. It is the bond digestion process. If auctions tail, the buyer is stepping back. If dealer take jumps, balance sheets are full. If secondary depth thins, yields gap. Then FX volatility follows, not leads. So, what do you do with that this week? You track 3 markers and you stay factual. Signal 1 is spot plus 1 week implied vol. Look at USD INR and the 1 week options gauge. If spot is flat but vol rises, stress is building under the hood. If spot rises and vol rises, stress is public. If spot stabilizes and vol drops, the system is calming. That tends to show up fast within a couple sessions. Signal 2 is the 10-year yield and auction quality. Look at the benchmark 10-year and the next auction stats. If yields keep climbing after auctions, demand is soft. If yields hold steady after auctions, supply is being absorbed. The lag is a few days because auctions are discrete events. Signal 3 is flows and reserves together. Look at foreign portfolio flow reporting, then the weekly reserves release. If outflows persist and reserves stop rising, the backstop looks less comfortable. If outflows slow and reserves hold, the backstop looks credible. The lag is 1 to 2 weeks, not 1 day. Now, stitch those into the stakes ladder. In the next 24 to 72 hours, the market is watching execution. A swap auction can anchor the front end. An RBI statement can shift expectations on liquidity. A clean bond auction can calm the whole chain. A sloppy one can restart the test. Over the next 2 to 6 weeks, it becomes a pipeline story. More auctions hit the tape. Positioning adjusts. Banks decide how much duration they will warehouse. Mutual funds decide how much they want in long bonds. Foreign investors decide if FX risk is worth the yield. If this persists longer, the macro trade-offs get tighter. Imported inflation can creep in if the currency stays weak. That can keep policy more restrictive than growth would like. Then credit conditions can tighten at the edges. That is where corporate borrowing costs and loan growth show it. Bring back the importer one last time. Now add a new consequence. If yields stay elevated for weeks, their bank's own funding cost rises. So even if USD INR stops falling, the importer can still face wider spreads on hedges. That is the hidden cost channel. It slows orders before it shows up in GDP. This is also why you should watch mismatches. If equities bounce while yields climb, that is a cross-asset disagreement. It can be real confidence in growth, or it can be liquidity pushing stocks while bonds price supply. You do not need to guess. You just see which signal resolves it. If vol drops and yields stabilize, the bounce was real. If vol rises and yields keep lifting, the bounce was a pause. If flows keep leaving, the system remains sensitive. None of this is a forecast. It is a map of pressure points. Markets can digest big borrowing plans smoothly. They can also stumble when liquidity is thin. The point is to watch the tape in the right places. So here's the recap. India's budget set a large borrowing plan. Bond yields pushed higher on supply worries. The rupee hit a fresh low, then snapped back. The RBI's swap tool sits at the center because it touches FX and rupee liquidity at once. And here are the 3 signals again. USD INR spot and 1 week implied vol, the 10-year yield and the next auction stats. FPI flows alongside the weekly reserves print. If those 3 cool together, the stress is fading. If they diverge, the stress is moving. That's the risk, and that's the recap. If you want the clean signal check, look at those 3 markers this week. I'll see you in the next one.